Good evening everyone. I Patik the Traveler welcome you to my YouTube channel. Today I came across a beautiful report of India Infoline about why the markets are falling in India. So let me go through that report and also give you some of the commentary on the same by me. But basically I am referring to the report on why is market falling by India Infoline today. This report was published today evening. So the Indian market has been reacting to the weak global cues with Nifty correcting around 5% from the recent highs while the Bank Nifty has corrected 7%. The selling has been broad-based with mid-cap 100 and small-cap 100 indices too falling 7.8% in last 3 days. In this note, we are listing the reasons behind this sharp correction which has spooked the investors. The first reason is unwinding of the positions of the yen carry trade. Before we dive deeper into this, it is important to understand what is the yen carry trade or simply a carry trade. CARRYTRADE. A carry trade occurs when the investors borrow from a country with low interest rates and a weaker currency and reinvest the same into another country with a higher return. Yen carry trades were most popular as volatility stayed low in the pair, with market participants expecting that Japanese interest rates would continue to be at the historic lower levels. It is believed, or I think it is a fact, that for almost last 17 years, Japan has maintained the 0% interest rate. And that's why what would the people do is that they would borrow yen from Japan and they would get it at a very cheaper rate because the interest rate was almost zero, and then they would invest it into a country where there is more return, for example India. So for example, if they make 4% on the yen that they have borrowed from Japan, where they are paying around 0.1 or 2%, and in India they are getting 4% returns for the same yen, then obviously the margin of 3.8% is their profit, and it is a classic example of what is called a carry trade. Now what has happened is Bank of Japan has now raised the interest rate to 0.25% from almost 0%. This was the second hike since March, when the central bank ended its ultra loose policy after 17 years. So Japan, Bank of Japan, Central Bank of Japan, like RBI is the Central Bank of India, Japan's central bank has not only raised the interest rate up to 0.25% in last 3 months, but it has also kept the door open for further rise. Now what does it do is that those people who have basically taken a carry trade in yen and invested in other countries like India, they would have to basically make sure that they take back their investment. Otherwise their investment may become loss making. Because not only that they would have to pay more interest to Japan for having taken the yen on loan, because now Japan has raised the interest rate. It would also mean that yen would become more strengthful. I mean its strength would rise because what Japan Central Bank is doing is it is also selling yen in the market. It is trying to basically support yen from further falling, and because of that I hope you understand that it would also mean that their returns in rupee terms would depreciate, because so to understand this, it is like this, that if I am an Indian investor and I invest in the USA in rupee terms, so for example if I invest 100 rupees in the US market and if rupee appreciates, then actually my returns go down, because ultimately when I invest in US market, although I have invested using my Indian currency, actually the investment is into dollar terms. So if I am an Indian investor who has invested in US market, then actually I would love to see the rupee becoming weaker, because rupee strength would mean that my returns would go down. The same way those who have taken yen from Japan they have taken the loan of yen from Japan and have invested in other markets. Because the yen is appreciating against dollars and other currencies, it means that their investment would actually create a problem for them. Now what is happening is that these investors have invested trillions of dollars in all the markets of the world. So now they will take back that money, and that will lead to, obviously, because a lot of money will go out of the markets, like from Indian market also a lot of money will go out which has been invested through yen. That means obviously the market will fall. The market expects further rates hikes in Japan, and the Japanese government has also intervened with 36.8 billion currency intervention after the yen fell to a 38-year low of 162 against the US dollar. The intervention coupled with the hike in the interest rates helped the yen strengthen from 162 to 142 against the dollars. It is an appreciation of 12.5% in a matter of days. Investors had to rush to exit carry trades to cut their losses short. The Japanese investors hold equities worth nearly rupees 2.05. Once again, the Japanese investors in India hold the equities worth rupees 2.05 trillion in India, and a stronger yen prompted some selling by such investors, as we just understood, because for them an appreciating yen means, or a depreciating rupee against yen means their basically investment in India would become loss making. The other reason why the market witnessed the bloodbath is the US recession fears. US Federal Reserve, that is the RBI equivalent of authority, okay, Central Bank of US Federal Reserve, in its last monetary policy meeting on 31st July 2024, hinted at a probable rate cut in its September meeting as a weaker than expected job data coupled with a falling inflation environment. The US unemployment rate jumped to 4.3% in July, which is a 3-year high and was the 4th consecutive month of an increase in the unemployment rate. This is leading to recession fears with crude oil at 8-month low as demand wanes. According to CME Group's FedWatch tool, the market participants are now pricing in a 71% probability of a 50 basis point rate cut in September, up from 31% before the data was released. The market participants are also expecting an emergency 0.25% rate cut in the next 1 week. Worries over the earnings of the tech stocks have also led to the Nasdaq 100 falling 17% from its recent highs in July. And Nasdaq 100, as we all know, is primarily made up of the tech companies like FANG companies, Facebook, Apple, Netflix, etc. And we recently also came across a news where Intel has already decided to lay off 15,000 of its employees. So basically, the recession is knocking the doors of USA. China and Europe are also facing a slowdown in the economy amid an escalating geopolitical tension, which is further adding pressure on the markets. The third reason why market witnessed a bloodbath today is the Iran-Israel war escalation. US Secretary of State Antony Blinken has warned that Iran and Hezbollah may attack Israel within the next 24 to 48 hours and has urged the G7 members to use diplomatic pressure to avert this regional war. This was after Israel announced that it had killed a Hamas leader. Any further escalation could lead to sharp rally in oil prices, which are currently at 8-month low. And the last point given is rise in India's VIX, that is volatility index of India. There has been a sharp rise in India's VIX index as a short gamma positions ran for cover. The Indian VIX index is up nearly 40% in a day and has risen to 20 after being at lower levels since Lok Sabha elections, etc. The rest of the details are very technical, but I thank India Infoline for this wonderful research report, and I'm sorry for that mobile fell down. Thank you very much for listening to me. Good night.